Hi, and welcome back to Investment Banking University's course, Investment Banking. We are talking about finance right now in the portion of the course, and particularly analyzing value with models. So as the economic existence of the perpetuity continues to grow, and we're ultimately tracking value, one becomes interested in the value of the perpetuity, the valuation. So we're going to talk about finance, which is the concepts, methodologies, and models that allow us to understand the valuation of the perpetuity. So strategics, financials, and entrepreneurs undertake investment with the expectation of NPV, net present value, and IRR, internal rate of return. They accept projects that have positive NPV and IRRs higher than the cost of capital. We're going to talk about exactly what that means, and those are often referred to as hurdle rates. They actively find and structure positive NPV projects and then match financial products to them. The positive NPV project is ideally a perpetuity, with the value of the business or opportunity being the perpetuity value, cash flow over the discount rate. Calculating NPV and IRR is the main analytical work of finance. We're talking about a growth statistic as well, CAGR, we'll talk about that, and that's yearly IRR. So with finance, we're ultimately taking accounts from accounting and translating those into models to be utilized in finance to make decisions on behalf of the corporation. From accounts to models. To go from accounting, to a financial number, we use models. We only use free cash flow to determine valuation for major transactions in a capitalist economy, even though there are different ways to do valuation, including market-based metrics. To go from account filings to models, we need to clean the numbers or scrub the financials or normalize the financials. This amounts to recasting accounts to get to a financial number. We try to get to a finance number to then utilize that for valuation. We get to valuation to then take actions. So in terms of modeling, after getting to valuation, we can then model a different action to take in order to increase the valuation. And we do our modeling in Excel, which we're going to be talking about. And just like our account statements, our models are built in Excel. We then utilize our models to run an analysis of the account statements. So the analysis of the account statements can take the form of ratio analysis, but we're going to go past that in this course. And has various uses from a liquidity perspective, commercial bank perspective, activity perspective, profitability, and growth perspective. So when we are talking in terms of analyzing value with models, we're going to first have to model value or model the perpetuity. So continuing deeper into the field of finance, we now discuss the actual work associated with understanding the value of a perpetuity. And this work is done by modeling the perpetuity in Excel, as we talked about. So we're going to be talking a lot about finance with Excel, and we're going to be talking about the different financial concepts in the context of Excel. So one expresses their decisions using Excel. Excel is a premier business computational tool. We implement financial analyses using the tool for financial analysis, which is Excel. And this is done with the valuation process. And the heart of finance that we're going to be talking about is ultimately the time value of money and discounting. And we utilize those, of course, in Excel. The Excel concepts used in finance, we're going to first write down our variables, which means defining the parameters of the decision. We use absolute or relative values equals A1, or we're going to use the dollar sign, which is which takes our absolute value. And formulas, for example, equals fx, and then we're going to use the brackets to define the formula, which are preloaded in Excel. Or we're going to be doing data tables, which are sensitivity tables to express decisions or changes in decisions at different levels of the variable. In terms of expressing decisions with Excel, we're going to implement financial analysis with Excel, as we discussed, and using a financial model for decision making to aid in the investment decision. The ability to get financing from financial institutions depends on the ability to make a financial model for a new and existing business. The financial model projects the future earnings from the organization and predict the future performance of a firm. Account statements report what happened to the firm in the past. A financial model predicts what the firm's accounting statements will look like in the future. We start by taking initial account statements and then inputting them into Excel. The difference between accounting and financial model is in the current assets and current liabilities. The financial model, we are concerned only with operating assets and operating liabilities. We exclude financing related items. The financial model has three components: the model parameters, which are the value drivers, the financing decision assumptions, which are the mix between the debt and equity and what the firm does with the excess cash, repay debt, payments to shareholders, or cash balance, and then ultimately pro forma financial statements. Cash in the financial model is a plug. The plug is so that the balance sheet balances. Cash equals total liabilities and equity minus current assets minus net fixed assets. The plug is the balance sheet item that guarantees the equality of the future projected total assets and future projected total liabilities and equity. Every financial model has a plug, and the plug is almost always cash, debt, or stock. In terms of the financial model and evaluation process, we start with our assumptions, our value drivers, and then we have the existing account statements, income statement, and balance sheet, and then we ultimately project financial statements, get to a free cash flow calculation, a terminal value calculation, a valuation calculation, then ultimately sensitivity table for major value drivers to see a range of valuations depending on the value drivers. So once the financial model is complete, i.e. the account statements have been projected, we can then use the model to value the firm by projecting free cash flows, determine the ability of the firm to pay its debts, credit analysis. In terms of using a financial model for decision making on the financing decision side, all companies must decide how to finance their activities, and this speaks to the proportion of debt and equity. The discount rate should be appropriate to the riskiness, variability, or beta of the cash flows being discounted. Discount rate is also interest rate, cost of capital, or opportunity cost, and we're ultimately going to be computing the annualized IRR in order to find it. The cost of capital of an investment is related to the risk of the cash flows of the investment. The relationship of individual asset returns to the risk is called the security market line. We can use the security market line to get the discount rate for individual investments. The security market line is used for private companies. The cost of capital for an organization is related to the risk of the combined riskiness of the investments in the portfolio. The relationship of portfolio returns to the risk is called the capital asset pricing model, or CAPM. You use CAPM to get to the discount rate, i.e. cost of capital. When the investment is a public security, you can use CAPM since the buyer of the security will have a portfolio to diversify away risk. Portfolio risk is associated with statistics. In terms of wealth maximizing decisions, on the investment decision side, we're ultimately asking what is it worth, and we're going to be utilizing NPV of a strategic alternative. On the financing decision side, we're asking what does it cost, and we're going to be computing the IRR of financing alternative. In in a capitalist economy, cash is king. Wealth maximization has to do with maximizing cash. Cash in the context of an organization is known as cash flow. Return is a word for cash flows, and we're going to talk about return a lot in this course. So cash flow definition, free cash flow is profit after taxes plus depreciation, which is a non-cash expense, plus the change in net working capital. We're going to have a negative sign is if there's an increase in current assets, and a positive sign if increase in current liabilities. And we'll talk about why in just a second. Capital, as well as capital expenditures or CapEx. After that, we add after-tax interest payments, and that gets us to free cash flow or FCF. The role of the finance professional is to quantify the cash flows and risk of strategic alternatives available to the individual organization. And this speaks to, related to the perpetuity, we're understanding at a high level that the formula for perpetuity, cash flow, the benefit stream, quantifying the cash flows, and the risk, the R, of the strategic alternative or opportunity. So in terms of capital markets are made up of cash flows and discounts. Capital markets and information, as it relates to that, information is valuable in determining investment and financing decisions in the capital markets. Overall markets are weak form efficient, meaning that their valuations reflect previous stock price performance, stock price data, and are sometimes semi-strong, meaning that valuations incorporate all public information. Capital markets are not strong form efficient, meaning that valuations do not reflect private information. In terms of multiple investment and financing decisions in a portfolio context, when there is multiple investment and financing decisions, we have something called a portfolio. The discount rate can be decreased by diversifying with a portfolio. When the discount rate is decreased, the valuation of the portfolio increases as a cash flow has more value. A corporation or organization is simply a portfolio of sources and uses, a portfolio of projects, and the financial products matched to those projects. In terms of modeling a strategic alternative, we put all variables, value drivers, at the top of the spreadsheet. And we're going to see that in Excel. We never use a number where a formula will also work. We use blue for hard codes and black for links and outputs. In finance, exchanging value through time, assets have a time dimension. Future value function equals FV, and then the brackets. Value in the form of a sum of money compounded into the future is what we're ultimately looking at there. In terms of present value equals PV, brackets, the value today of future payments discounted to the present. Net present value, or NPV, is equal, in terms of Excel, equal negative first payment plus NPV brackets. And this is the incremental wealth increase earned by a strategic alternative. NPV tells you the economic value of an investment in today's dollars. Always use NPV in the investment decision. In terms of internal rate of return, or IRR, we're using equals IRR brackets, and this is the compound rate of return earned by a strategic alternative. And in addition to that, we can also see the cost of capital. So rate of return versus cost of capital. What is the asset's IRRs? We're asking that question. We compare to the cost of capital effective annual interest rate, which is the annualized IRR used to compare financing alternatives, aka the compound annual growth rate, or CAGR. In terms of cost of capital, we calculate the IRR of financing alternatives to determine the cost of capital. We need to get IRR in annual terms to facilitate comparison. And we may have to start with monthly IRR to then annualize. And we do that by taking annualized IRR is equal to 1 plus the monthly IRR in brackets. And we raise that to the n-1 power. Finding a value in a financial model, when we need to do that, we use what's called goal seek. And so we want to use another cell, and we want to find a value by setting a particular value in another cell. We use goal seek, and that's Alt-AG, as we're going to be able to do that. And we're going to talk about how to do that a little bit later on in the course. In terms of financing alternatives with loan amortization, we're going to have a few different functions. And the first one is payment. So to calculate the debt payment per period, we're going to be using PMT. To calculate the interest portion of the debt payment of debt, we're going to be using IPMT. To calculate the principal portion of the payment, we're going to be using PPMT. And then in terms of direct comparison of financing alternatives, we're going to be looking at the IRR of the differential cash flows that tells you the cost of the different options. And so the IRR tells you the cost of the financing alternative. So that's what we're going to use as the basis of comparison. Of course, we want to minimize the cost, and thus we want to minimize the IRR. So CAGR is the effective annual interest rate, which allows for comparison. In terms of analyzing the strategic alternative, we can use a sensitivity table, is ultimately what we're going to be doing in investment banking as well at the end. And the data table is, of course, Alt-AWT in terms of the hotkeys. And it tells you how the output changes with incremental changes in the inputs, i.e. the variables. The financing alternative, nominal versus real cost, and determining the true cost of a financing alternative, it's important to use the real interest rate, which incorporates inflation. The real interest rate is determined by using the real cash flows. Inflation itself acts as a discount rate, which is why we need to incorporate it. In terms of strategic alternatives analysis, we're going to be dealing with NPV as well as a hurdle rate in the form of an IRR. So for each strategic alternative, we can compute the NPV and IRR and then have decision rules for the investment, a minimum NPV and then a hurdle rate for the IRR. You're using NPV and IRR to make investment decisions, but you need the discount rate. The discount rate is associated with the financing decision. In terms of cash flows and risk, are the cash flows riskless, i.e. treasury bills, or are they risky, i.e. the market portfolio, for example? Cost of capital and opportunity cost, the returns of similar investments, should be used as the cost of capital. For the discount rate, an organization's discount rate is the cost of equity and cost of debt. The cost of the total capital structure is known as the weighted average cost of capital, or WACC. And the formula for WACC is equal to the risk of the equity times the proportion of the capital structure made up by equity, plus the risk of the debt, which is tax